Can you achieve extraordinary results while making the world a better place? I'm Bruce Temkin, and together we'll explore how. Welcome to Humanity at Scale, Redefining Leadership podcast. Join me as I speak with visionary leaders and top experts to uncover the secrets of humanity-centric leadership. Ready to rethink leadership? Let's dive in. At Humanity at Scale, we explore what it really means to lead with impact, not just by driving business success, but by building organizations that put people and purpose at the center. One of the biggest leadership challenges today is earning customer trust in a world where expectations keep rising. Too many companies chase short-term wins. But what if the real key to lasting success isn't transactions, but loyalty? Today, I'm thrilled to welcome Fred Reichheld, the creator of Net Promoter System and a leading authority on customer and employee loyalty. Companies like Apple and American Express have integrated NPS into their approach to growth, using it to better understand customer relationships and drive long-term success. In his latest book, Winning on Purpose, Fred makes a bold case. The primary purpose of a business should be to enrich the lives of its customers. And that's the real path to long-term success. He also introduces earned growth rate, a metric that links financial success directly to customer loyalty. We'll explore how loyalty drives great leadership, why putting customers first leads to stronger businesses, and what the future of trust and growth looks like in an AI-driven world. Fred, welcome to the podcast.
Nice to be here, Bruce.
Great. Well, Fred, you spent decades championing the ideas of customer and employee loyalty as fundamental to business success. How would you summarize the story of your career?
Well, I started at Bain Company back in 1977, and shortly thereafter started to notice that there were companies that were performing far better than the basic rules of strategy would explain, at least the basic rules that they taught at business school, and I think we endorsed at Bain at the time. These companies sometimes were small, sometimes large, high-tech, low-tech, but they were outperforming everyone, and the core, this common theme we finally discovered was they had better loyalty from their customers and employees, and it transformed the economics of those businesses. And it led me to a point of view that maximizing profits is not the right objective for a great business. Maximizing shareholder value doesn't work either. Leads you down some very ugly paths. On the other hand, enriching the lives of customers not only makes customers better off, but it leads to great opportunities for employees to have meaningful, prosperous careers, and in the long run delivers the best results to shareholders. So my worldview has shifted from what I learned in business school, which is focus on the financials, and sort of the private equity view of the world is how much value you can pull out of a business. As long as it's legal, it's good. I think that's suboptimal. I think a better point of view for everyone is we got to innovate ways to make our customers' lives better.
Great. And I think we're going to go into some of that. I want to go a little bit deeper into the younger Fred who goes into Bain and has this view on what real value looks like. Were you a renegade at Bain with this idea, or were you just sort of following the lead of other partners who had similar ideas?
That's a tough question. I think the thing that distinguishes Bain, among other things, is a commitment to real results, not just fancy sounding and short-term results, but we were probably the first of the consulting firms to recognize you got to put your own money where your mouth is, or you're not very credible. So we began investing in companies, and then built our own private equity sister company that spun out, became Bain Capital. It's one of the major players in that field today. But almost everything we do is the truth serum is would you invest in that idea, and we do, and so what's radical for me versus probably most other consultants, except at Bain, is when we discovered the Net Promoter Score as a good proxy for loving your customers. And I found companies who were doing better than the competition at treating customers with loving care that I invested in them. And as long as they weren't Bain clients and there's no insider trading issues, I just built a portfolio of loving companies, and it has crushed the stock market. It's made me a wealthy person. It's sort of astonishing. Was I a renegade at Bain? Not a renegade, but I definitely had a different point of view, and probably still have a different point of view than the average Bain partner, where everyone would agree that customers are important. I think customers are central, and I hope that point of view grows in popularity.
So if you think back, you have this view on customers, you see that the companies that love their customers, treat them well, outperform their peers, right? So it's great that you made money in the stock market, you bring it to your thinking at Bain. How did that translate into the Net Promoter Score as the proxy? Did you try it on different places? Did you see people already using something similar?
When I wrote my first book, it was called The Loyalty Effect. So it's 30 years ago or more. And the reason I got all stoked about the need to write about it was the current metric that was being used to gauge customer centricity was customer satisfaction scores. And there was an organization that was sort of the kingpin and the world's expert called ACSI, American Customer Satisfaction Index. They were published in the Wall Street Journal, which had a quarterly marketing page. They were front page, top, above the fold, big news. Here's the satisfaction scores for all the big companies. And I started investing in those leading companies, and it didn't work. At least the way that these market research mavens were measuring satisfaction did not explain superior performance for investors. And I thought, geez, this is a fraud. And then they said, oh, they threatened to sue me because I would say in my keynote speeches what I was finding. And the founder said, I'll sue you and I'll bankrupt you if you keep saying this. So the Bain public relations guys said, Fred, there's no need to, just keep it to yourself, which I did. But then I saw, but the problem was this well-accepted way of measuring customer happiness didn't link to true economics. And subsequently, I saw that the ACSI actually created a mutual fund, an ETF, that invested on these insights. And it's been in the bottom quartile of performance every year since it was founded. It's horrible. And that destroys my theory. It undermines the idea that customer happiness. Now, what's the difference between satisfaction and what I measure? They're similar ideas. It's just one starts with behaviors. It doesn't just do a market research study and think about the word satisfaction. That means you give customers enough, not way more that actually delights them and turns them into promoters. Enough, that's what most people think is you want to satisfy customers. You don't want them to defect and create the leaky bucket. That has terrible consequences. But don't overinvest in them. Don't treat them like they're the most important stakeholder in the business. So that really motivated my early writing, and I linked it to microeconomics. When the New York Times reviewed this first book, they said, geez, Reichheld put loyalty economics on the map. I think the reason is because I looked at it like a Bain private equity person would. You invest money to get a customer in the door, and then if they stick around over time and you treat them well, they buy more, they expand purchases, they refer their friends. Their cost to serve goes down as a percent of revenues, and quantifying those benefits makes it very clear. If you really earn loyalty of customers, you have a huge cash flow advantage that can be redeployed to innovate and make things better for customers and pay your employees and pay your investors.
Yeah, so it's interesting. You have this compelling story around the connection between the Net Promoter Score in the system and financial results. Yet, decades after NPS was created, there's still some people in the industry that doubt its efficacy,
Oh,
right?
I
There
think
is still.
most people in the industry, and to be
So
honest,
why is that? Why is that?
most people do NPS horribly and misapply the ideas. So you have crappy data that doesn't link up to economics, and they're worrying about, oh, gee, shouldn't I have different 0 to 10, is that the right measure? And shouldn't I normalize for the rural versus urban effect? And they make it complicated. It's really simple. You just got to figure out, are you enriching a customer's life and turning him into a promoter or not? Because that's success and failure. And so you have to calibrate your feedback process so that it links up to those real behaviors, which is what you're trying to substitute for. And in today's world, you don't even need surveys. You just watch their behavior, watch referrals, watch expanded purchases. That helps you understand promoters versus detractors. Surveys was just my middle ground of advancing the state of the art. Surveys, we're sick of surveys. You don't need surveys to do NPS.
It's interesting. So I always, that was part of the discussion. I've sort of advised hundreds and hundreds of companies that work with NPS and other systems. And the argument I always say is, if you're using NPS, you can't debate that you want to create promoters and you want to get rid of your detractors, right? At a fundamental level, you can't sit in a boardroom and have that debate, right? That's you don't succeed with more detractors and fewer promoters. But somewhere along the line, the connection with the system gets broken.
Yeah, and it's usually crappy. It's crappy measurement. People think, oh, I've got a 3% response rate or a 10% response rate. I can just take that sample of people who responded to a survey and presume that it's representative of the 90 or 99% of the customers who didn't respond to the survey. And that's bogus. It's just anybody with a college degree in statistics, or college, high school, common sense knows that that's wrong.
So let's say you're advising a CEO today, given the state of the art of processes that people know, of technology that exists. What would you recommend to a CEO on how they should include NPS in their leadership approach?
Well, I think the only way to have it as a rigorous metric that you would link to compensation for the senior team is to have a relative NPS score versus your key competitor measured on an apples to apples basis. That's how I decide who to invest in winning on purpose. The companies that I saw as the leaders in NPS wasn't because I just took their internal statistics that were using customer satisfaction style process and calling it NPS. That's bogus. We built a business at Bain called NPS Prism that actually rigorously builds panels of customers and double blind research and true NPS that can be compared to competitors. That makes a lot of sense. But panels are complicated and they're expensive and they're not what you run business decision making on day by day. So my strong recommendation to C-suites today is, for heaven's sakes, you got perfect signals of whether you've delighted a customer or not. They refer. You got to understand how to measure and manage this referral flow. It's the most important piece of data in business that you don't understand.
Great. So you brought up the book. Let's move on to discussion on winning on purpose. What drove you to do that, to write that book? Was it a flaw you saw in how people were using NPS, or was it an aha moment that said, there's something else that I want to write about and talk about?
When we wrote The Ultimate Question 2.0, I really thought my work was done here. I sort of, it's open source. Everybody could use it. Most of the world seemed to be using it. And then I got sick. I got a cancer diagnosis. I'm off the field for years, and watching how my baby is being destroyed and mutilated by well-intentioned executives applying classic customer satisfaction baloney to a metric and thinking because they were using my metric somehow they were fixing the ridiculous sampling errors and biases they were putting into their system. So winning on purpose was just trying to get the movement back on track and remind people of the core philosophy underlying Net Promoter, demonstrating that it worked even more relevantly in the digital age and the oncoming AI age, and then laid out the best practices and worst practices so people could stop doing the stupid stuff and transition appropriately to not measuring a score, especially a survey-based score, but focusing on signals like referrals and repurchase. One of the early guys that influenced me was Andy Taylor, the CEO of Enterprise Rent-A-Car, who built it from a tiny family business in St. Louis, Missouri, to largest car rental company on earth as a private company with no need for outside cash. It's when you do this right. And I asked him, this is sort of amazing. You blasted past the Leviathans like Hertz and Avis and Europcar as a tiny little family business. And, at business school, I learned that's impossible. How did you do it? And he said, there's only one way to grow a successful business, Fred. You treat your customers so they come back for more and refer their friends. And that simple idea remains a black box to most businesses because they don't take the trouble to keep track of which customers are buying more or less and which ones are referring their friends. That's invisible to them. And so the thing that Andy Taylor and the other brilliant executives who are NPS leaders, what is turbocharging their engine of growth, back for more and bring your friends, is not tracked by accounting. And so it's invisible to the average business person in the C-suite of a large company. So my goal is to get people that, for heaven's sakes, the common sense is irrefutable. You got to measure and manage back for more and bring your friends. And don't just take what the accountants are spoon feeding you, because it's only relevant for a part of your business challenge.
Yeah, no, I go back to what Walt Disney said, right? Which is, do what you do so well that they want to see it again and bring their friends. I think that's sort of the basis for all that, right?
Oh, Costco, the lowest cost player out there, monster, global company. Customers first. We do everything in the customer's best interest. Apple, same thing. You see them only acting in the customer's best interest. They don't sell their data like most of the other companies. They really have this philosophy of enriching customer lives as the central mission, the North Star. And look how rich their investors are, and look how rich Costco's investors are. And so it's sort of frustrating to me to see this core truth that is proving itself out, even in the Bain truth. Fred, if you're so smart, why aren't you rich? Well, I am rich. And I've actually put it in chapter 5 of the book, and I've shown you how this portfolio beats the market by five times. But the mindset of how people see business, it makes it very hard to see the truth.
So it's almost like, if I was to paraphrase a little bit, and I might get it wrong, so push back. But if you're talking to a leader, said, all right, forget about measurement for a second. What you need to do is understand, by your segments of customers, what is it that you need to do for them and with them to make them want to refer you and to actually refer you. So whatever you have to do to understand that and put it to use is what you then need to build.
I'd say it slightly differently, because the way you described it makes it too easy to misunderstand. I know you understand, but I would say loyalty is a word, love is a word, trust is a word. Its meaning is very, very difficult. On the other hand, you can spot a behavior. A person refers a friend. That's a real thing. It has real economic consequences, and you can dig into the root cause to probe why that person, what inspired that referral, what made that person's referral so credible and influential that it actually influenced a customer to buy. That's real stuff, and those things have real economic consequences. Same thing with a detractor. When somebody leaves a business, they're so disgusted and disappointed, they go away. That's a real event, and you can dig in and understand why and what you need to do differently. And so focusing on both tails of that distribution, the true promoters, not just there's so many courtesy 10s on surveys today, it's ridiculous. Someone who really generates a new customer for you is a true promoter. Focus on understanding why and do more of that stuff and get more of those kinds of customers. That's the number one priority. Number two should be, and for our detractors and our people who are leaving, make sure you apply the learning there. That's why it's called net promoter. Promoters minus detractors. Both tails of the distribution. Probably the biggest disappointment I have is 20 years after putting net promoter into reality, I'd say 95% of the effort has gone toward the bad side of the equation. Fix detractors, fix the errors. It sort of fits the quality manufacturing mindset, the Toyota and others, zero defects, and the cost of a defector is very easy to calculate. But 95% of the energy should be innovating to delight more customers and generate referrals. That's what drives growth. And only the smartest and most innovative companies have put the energy where it should be.
It's interesting. So you talk when you were talking about sort of understanding that referral, I saw in my head like I could see another book, a side book from Winning on Purpose, which is The Anatomy of a Referral, right? Like just how do you dig in and really understand the elements of a referral and make that central to your learning.
How do you measure it too? Businesses, they would say, the founder of Chick-fil-A, another like Andy Taylor, I mean, Truett Cathy, a totally different personality and way different than my point of view on many things, and yet he had this core philosophy I completely loved and have taken as my own. He said it's really a biblical proverb. It's from the wisdom of Solomon, essentially. I think it's the third section of the Talmud has this idea that a good name is worth more than silver or gold. And it's true. It's a 5,000-year-old idea. And yet businesses haven't figured out how to measure that today. A good name is how many people are referring you to their friends, to their loved ones. That is the perfect litmus test of have you enriched a life, treated someone the way you'd want a loved one treated. And most businesses haven't figured out how to track it and measure it. Good ones, when they're smart about it and build modest incentives in so people sort of give referrals through a measurable process, they're just light years ahead of knowing what they need to do to get better. FlexJet, the company I use for my private jet fractional share, they just sent me the CEO sent an email out and said, we're proud that almost 50% of our new customers last year were referred by our current customers. And I say, brilliant. If they were a public company, that would be the signal that I would probably want to invest in them. How many companies could tell you with any confidence what percentage of their new customers last year came primarily as the result of a customer referral? And that's the state of the art. This is almost a 50-year career, and the businesses are still at this. They are not even crawling yet.
So since we're talking about measuring and getting that right, your book also introduces a concept of earned growth rate. Do you want to share with the audience what that measurement is and how you're seeing it fit in this story of customer loyalty?
Yeah, I told you the story of Andy Taylor and how do you build a great business where you treat customers so they come back for more and bring your friends. You don't create one who sends out a bunch of surveys and links compensation to survey scores. That wasn't what he said. It's back for more and bring your friends. Those are measurable, and that's what earned growth is. It says stop messing around with surveys unless they are helping you learn how to get customers to come back for more and bring their friends. To know that, you know to keep track of back for more and bring your friends, and that's earned growth. When you treat people so they repeat and expand and refer, that amount of revenue is what I think of earned revenue. And then sometimes it makes sense to buy revenue, invest in new customer acquisition or acquiring another company, but it only pays off, that investment only pays off if a lot of those customers that are new become promoters who then refer their friends. The math just doesn't work in most industries unless you turn a customer into an asset. If you just buy the growth, through promotions and marketing and schemes. It looks like you're getting growth, but it's evanescent. It's fleeting, and you have to. It's an addiction. Then you have to replace more of that disappearing growth. The key is earning your growth, and when you acquire new customers by buying them, make sure they are then compounding the interest of growth by becoming referrers themselves.
Is there a set of recommendations you have on how a company can sort of establish the earn growth rate in their firms?
Yeah, number one is just make it really clear which customers are buying more and which ones are buying less. Sometimes it has to be versus a relevant cohort, like a segment of customers or their tenure. But you got to have a signal based on purchase pattern of, does it look like these are real happy customers or not so happy customers? And then most importantly, figure out how to measure referrals and identify, illuminate this black box so you can probe into it to understand its health, what's driving it. And that should drive business priorities so much more than the way most businesses, my colleague at Bain, Daryl Rigby, he says they have spreadsheet strategies. They sort of put it together in a business school and, geez, we don't have enough profits to keep our shareholders happy, so we got to squeeze here. And, it's just baloney. The dynamics of generating cash in a business is basically customers coming back for more and referring their friends. All the other is second and third order effect. And so get to that core process and measure what's vital, and then get it in front of your frontline teams, not just once a quarter. This has to be there every day so that they can learn from, what's improving repeat purchase and referral and what's destroying it. And if you're going to have AI in your business, for heaven's sakes, make your objective function that it learns on back for more, and especially referrals. Because back for more is not always reliable, especially in business to business. You buy a certain kind of software, you're stuck with it. So you'll keep buying it, but you just almost never refer to a friend unless it is a great opportunity that if you were starting over again, you would buy it yourself. So that referral is a pure, more reliable signal that AI and frontline teams should all be learning from.
Awesome. Well, you just transitioned into sort of the last set of topics that I want to touch on with you, which is sort of AI. You've been around for a while. You've seen organizations operate probably through many technology cycles. How do you see AI playing into the future of customer loyalty, either positive attributes or negative attributes of what you think is gonna happen?
Well, AI has enormous potential. I use it myself regularly, and it makes my life better. I don't like the way I see my suppliers using it to rob me legally. There's the classic surveillance pricing and dynamic pricing, and I don't want to let you, you're not worth it to me to put a human being in front of you when you need service. I'm going to make you talk to a chatbot. That just, I hate it. So many of the applications now being pursued by businesses are horrible. It's learning how to serve me cheaper and keep me just satisfied enough so I don't defect. And that's not back for more and bring your friends, because if those AI use cases were searching out ways to make my life better, there are so many opportunities. It's awesome. But thus far, I'm very, very disappointed in how large companies are rolling out their AI. It's cost reduction focused. It's cutting back service levels to the bare minimum before people get so mad they leave, and very little of it. I mean, I hope if you have an example to share, please do. But how many times have you seen companies using AI in a way you go, whoa, that made my life so much better. I'm going to give them a bigger share of my business and refer all my friends.
Yeah, I don't have a lot to share, but it's interesting on that front. But it's interesting that I think oftentimes it's easier to make the business case around efficiency, right? Those tend to be clearer, more distinct than business cases around opportunity growth. what's your recommendation for businesses to have the incentives or leaders to have the focus to push AI into that direction of making lives better for customers?
Well, I'm going to try and prove only through referral do you generate real cash flow. I invested in a company a few years ago that seemed promising to me in tracking referrals. It's a tech platform that called Mention Me that not only helps build incentivized referral programs so you can say to a customer, if you're happy with what your experience thus far, you can refer a friend, and we'll give you a discount on your next purchase or some special bonus, and we'll give equal value to that new customer to make sure there's a warm welcome. So it's a modest incentive. It's transparent. I don't love it because it seems artificial, and yet now I can track who's referring whom, how much they buy. Does that new customer then refer others? And that would have never happened if that initial referral hadn't happened. So you see this compounding chain reaction. And like all compounding phenomena, it's sort of shocking how compound interest. You give a kid, if you were rich enough, you give each of your grandchildren $1 million when they're born. They'll have $180 million if they wait until their retirement age to spend it. That's not intuitively obvious to most human brains. And the same thing as referrals. It's a compounding phenomenon. It's the compound interest equivalent of loving a customer. And that love gets passed on. So what I'll probably have in the next publication I do is, when we look at the value of a detractor versus a passive versus a promoter, even the Bain sophisticated analysts were finding that, if I put the passive at 100, promoters are worth 60 or 70% more. And it's mostly because we can track how much they buy, their lifetime revenues. But if you then can actually track referrals the way we do with Mention Me, you go, whoa, a promoter is not somebody who gives you a 9 or a 10 on a survey. A promoter is someone who actually refers you to a friend. Think about the word promoter. And for that definition of a true promoter, they're 300 or 400% more profitable than a passive, and that's only with their first generation of referrals. If you then take the full compounding effect through the years, you find out they're like 10 times more valuable. And suddenly it becomes clear where all the cash flow has come to finance the growth of Enterprise Rent-A-Car and Chick-fil-A and IKEA and other cash flow miracles. It's because when you generate really enthusiastic true promoters, you've got this compounding cash flow that is just invisible except after the fact to an accountant.
So it's interesting that compounding speaks more about lifetime value than present day results, right? And I know, work with companies I have, you probably have seen similar things. It's sometimes hard to break leaders from focusing on the here and now for things that have longer term opportunities for the organization. How do you shift that thinking so that compounding value is something they take into consideration when making decisions today?
Well, the only way to get a rational person to focus on the long term and lifetime is to develop a metric that's visible today that really does link and drive to those long-term outcomes. That's what Net Promoter does when it's measured in a Bain Prism rigor. When you see NPS, it's a pretty good proxy. NPS versus competitor measured the same way. It proves out. That's why you invest in the companies that we identified as NPS leaders. And 10 years ago, they beat the market by 5 times. Even after publishing the book, those leaders continue to double and triple the market. So the mindset of the investor doesn't get it and probably doesn't have access to the real information. So how do I get people to think about lifetime value? Probably show them that the only companies that are beating the stock averages are getting more of their customers through referral than any other source. And then if I can get a measurement process that lets them track how many referrals are being generated, what percentage of new customers are coming through referral, that then becomes a current proxy that they can start trusting. And so net present value is such a theoretical idea. On the other hand, what percentage of your new customers this month came in on referral? That's something I know how to manage and hold people accountable for.
Great. Well, I'm going to close out with 3 quick questions for you. The first is, if you could pick one leadership skill that would be even more important in the future, what would it be?
More than anything, it's loving your teams. Leaders who love their teams, in my mind, are the ones that feel committed to help them lead lives, meaning and prosperity, and that means putting them in a position to earn standing ovations from their customers. It's the only way that they can win is when they are serving their customers so well. They get this feedback loop of thank you, it's thanks and positive energy. You've made my life better. That starts the cash flow that lets teams get paid very effectively. And even without the pay, if you put a feedback system so they know and are getting recognized for enriching the lives of their customers, you've given them the greatest greatest gift you can give, which is a life of meaning and purpose, where there's a North Star that is guiding you toward the right life's mission. So I think leaders, I mentioned Winning on Purpose, Jim Collins' book, Good to Great, brilliant book, sold 5 million copies, but it doesn't mention the word customer until 50 or 60 pages in. And it's the common American, and maybe worldwide business, that somehow there's great leadership that is independent of whether your company is making customers' lives better. And I just think that's wrong. I think the only great leaders care for their teams in a way by setting up a system where they can earn a valued role on a team that wins for its customers.
You got a big hooray from me and probably all of my listeners on that one. Second question, I give all of my guests a magic wand to use for a couple seconds. And if you could change one thing that would make organizations more human-centric, what would it be?
Well, I'll go back to this referrals idea. If you could make it clear that when you touch a customer, are they referring more than they did before? It gives them a clear sense of, have I enriched a life? This golden rule, love thy neighbor as thyself, or treat people the way you want loved ones, or whatever the way you think about it, that increases humanity. You got to put yourself in the situation of that other person and act in their best interests. It's easier for parents because they can sort of think about their kids. It's even easier for grandparents to think about what's in the best interest of your grandchildren, make their lives richer and better. And I think to bring that home, it's, have I treated someone in a way that is so special and has so enriched their life in a way that makes them proud that they would refer someone they care about? And it just shines a light on the right things.
Great. Now, my last question is for leaders inspired by your work, and I'm sure there are going to be many, many. What's one final piece of advice you'd like to leave them with?
Read my LinkedIn blog, read Winning on Purpose. Maybe more importantly, give Chapter 5 of Winning on Purpose to your C-suite, to your CFO and your CEO, and ask them what the implications are for your company.
Great. And I'll put that in the notes, so I think everyone should read it and especially focus on Chapter 5. Thank you, Fred. That was great.
Pleasure.
Well, I hope you found my conversation with Fred Reichheld as insightful and thought-provoking as I did. His work reminds us that customer loyalty isn't just about marketing strategies or retention tactics. It's about leadership, culture, and a deep commitment to enriching people's lives. If you enjoyed this discussion, please share it with your colleagues and friends who are thinking about customer experience, employee experience, or purpose-driven leadership. And don't forget to subscribe for more inspiring conversations on what it truly means to lead with impact and purpose. Now let's dive into the after show, a segment where I'll reflect on the key takeaways from my conversation with Fred and share some additional thoughts on how leaders can bring these ideas to life in their own organizations. Thanks for tuning in to Humanity at Scale, Redefining Leadership podcast. Remember, true leadership isn't only about achieving short-term results. It's about creating a lasting, positive impact on all of the people you touch. Join me next time as we uncover more insights and strategies for humanity-centric leadership. Until then, I'm Bruce Temkin, encouraging you to lead with purpose and empathy and to be the spark that elevates humanity at scale.